In this video, we will talk about 3 terms used in the valuation of early stage companies that every investor should understand. These terms are pre-money valuation, post-money valuation, and cap tables, short for capitalization tables. Now, before we get started, if you're enjoying this content and would like to see more, please make sure to click the like and subscribe buttons and click the link in the description below for a one-page summary of this video. So let's get started with both the pre-money and post-money valuation. Pre-money valuation and post-money valuation are 2 terms on how to refer to the value of a company before and after an investment is made. To better explain this, let's use an example where an investor invests $2 million for 40% of a company so that the company would have a value of $5 million after the investment. Or in other words, the pre-money valuation, the value before the $2 million investment, is $3 million. The amount raised is $2 million, and the post-money valuation is $5 million. Let's make sure this is clear. The pre-money valuation is the valuation not including the investment. The post-money valuation is the valuation including the investment. That's it. When you're looking at agreements and discussing valuation, make sure that you understand the difference between pre-money valuation and post-money valuation. Next, let's move on to cap tables. A cap table, which is short for the word capitalization table, shows the equity capitalization of a company. You will usually find it in a spreadsheet format. The best way to explain this is through a simple example. And for this, let's look at our earlier example that has a pre-money valuation of $3 million, amount raised of $2 million, and post-money valuation of $5 million. Now let's add a little bit to this example. Let's assume that the founders of the company own all of the shares before the $2 million was raised. So the founders own $3 million worth of shares, and the new investors own $2 million worth of shares. Now, for our example, let's also assume that the founders own common shares and the investors own preferred shares. Preferred shares mean that in the event of a liquidation, preferred shares would be paid before common shares. Or in other words, they would be preferred to common shares in the event of a liquidation. Now, let's say that the common shares and the preferred shares trade at the same price of $1 per share. So if the price is $1 per share, then that would mean that the founders own $3 million worth of shares so that they would have 3 million shares, calculated by $3 million divided by $1. And the investors would have 2 million shares, calculated by $2 million divided by $1. But just to make this a little more complicated, let's say that the $2 million came from 3 different investors. Investor A invested $400,000, or in other words, bought 400,000 shares. Investor B invested $600,000, or in other words, bought 600,000 shares. And investor C invested $1 million, or in other words, bought 1 million shares. And if that's the case, then there would be total shares of $5 million. Now, let's put everything together in a, you guessed it, a cap table. As you can see in the table, we have all of the elements that we spoke of, including the names of the investors, capital invested. Notice that the founders did not invest any capital. The number of common shares, the number of preferred shares, as well as the ownership percentage. As you can see, the ownership percentage is just the number of shares owned divided by the total number of shares. Now I put a column for total shares here to make it easier to understand, but not everyone will add that column in a cap table. Also to mention, sometimes above the cap table, people will include the information we spoke about earlier, such as pre-money valuation, post-money valuation, amount invested, price per share, as well as other information. Now, the cap table that I just showed you is a simple example of a cap table. Cap tables get more complicated when there are multiple rounds of financing at different prices, employee stock options to be accounted for, and when there are more complex securities. Now, here's a final thought. Not everything will appear on the cap table. For example, the company may have an agreement that gives other investors claim to future equity. In other words, there may be a promise to give investors equity that has yet to be issued. A common structure for this is a SAFE, which stands for Simple Agreement for Future Equity, where early stage companies raise money from investors in return for future equity. Since the equity in a SAFE has yet to be issued, the details of the SAFE will not appear on the cap table. Investors should be aware of not only the current ownership structure, but also the potential future ownership structure based on agreements that the company has made. In this video, we talked about 3 terms used in the valuation of early stage companies that every investor should understand. These terms are pre-money valuation, post-money valuation, and cap tables, short for capitalization tables. If there are additional terms or topics that you would like to learn about in future videos, please leave them in the comments below. Thanks for watching our video. If you enjoyed it, please click the like and subscribe buttons. And in the description below, you'll find links to a free one-page resource, our website, and our LinkedIn page, where you could find more information on this topic and other private equity topics. Thanks, and we'll see you in our next video.